situation that we find ourselves in now, where there's a little bit of softening out there, right? That is contradictory to your underwriting model. You've got to be able to pivot, communicate to your investors, or make decisions based on what the market is telling you. There have been countless situations where people just want to dig their heels in and not really embrace change and embrace the market and what it's.
Welcome everyone to the podcast. Today, our topic is property management, and I'm honored to have as our guest, Mitch Harrison. Mitch is the CEO of First Communities, a property management company actively involved in managing over 50,000 units throughout the southern half of the United States. He is a licensed real estate broker, president of the Georgia Apartment Association, and current chair of the board for the Atlanta Community Food Bank. Welcome, Mitch.
Thank you for having me, Ravi. I'm honored to be here.
Yes, really happy to have you. And at the time of this recording, we were approaching Halloween. So I thought it'd be prudent that we shared some horror stories throughout this podcast. And when we were discussing this podcast, Mitch says he has many of them that he can share with us. And we're gonna talk about that and how he was able to transition out of those situations. So let's go ahead and start with this question, Mitch. You've been in property management for many years now. What's the most dramatic transformation or turnaround you've managed to pull off for a property?
Well, that's a great question. So yeah, I've been in the business now for 20 years, and First Communities, my company, has been around for 40 years. So look, there are countless stories, success stories that we've had over the years. I have, just to give you a little bit of background, I sort of worked my way through the organization, right? So I certainly didn't start out in the business. I was, I guess, adopted into the business from to put it in better terms. But I started out in after college. I was working actually in capital markets, and I worked overseas, and I worked up in New York, and I finally got I got introduced to a gentleman, my mentor and business partner, Rob Johnston, who started First Communities about 40 years ago. And he was there to really, in my vision, was to really take me under his wing and show me the ropes and show me sort of the intricacies and the relationship-driven business that is commercial real estate and multifamily. And so I was all geared up to be a part of the wining and dining and the relationship building and a lot of golf and the things that you probably hear about and read about from a commercial real estate perspective. And Rob had different plans for me. So Rob set about my course of and path of learning the business through real hands-on management. So I started working in maintenance 20 years ago at a property in Sandy Springs, which
I didn't know that.
Yeah, which was here. It's a suburb here of Atlanta, and that would probably be one of the better success stories, right? So this was a 393 unit apartment community, had located in a fairly decent affluent area of Atlanta, right? A suburb of Atlanta, but had been neglected over the years and there's been not a lot of capital put into the property. And so Rob and one of his business partners had bought the deal, and he thought that would be the best proving ground for me to really start my journey in the multifamily space. So he put me on site in charge of their renovation team, right? So, which I had no idea. And at that point, it was called a rehab, right? Which I had no idea what a rehab meant. I had only bad connotations to a rehab. But in this situation, the rehab meant they were going to put a lot of sizable equity into the deal and bring units that had otherwise been neglected for a number of years. The property was I think built in the mid 70s, right? So it was an all brick deal. It had some townhomes, but had just been neglected. There had not been a lot of equity that had been put in the deal, and yeah, it was a fairly well located asset. So, it really set me on the path towards really understanding this business at a grassroots level, and what it actually takes to take an asset like this, a heavy value add asset like this, that has really good bones, right? Good roofs, good. It was all brick, not a ton of deferred exterior maintenance, but had some good bones, but in a well located area, and just needed some TLC on the insides. And it had been neglected, and it had probably run in the probably mid 80s, low 80 percentile, a percentage of occupancy. You know, when probably didn't have the best demographic and clientele in there in terms of their abilities to pay rent on time or just take good care of the property. So I got to see firsthand a little bit of the dark underbelly of multifamily in terms of what happens when, when a property is not performing well, or it's under owned or under managed, and what can happen and what you have to do to sort of move the needle and bring it back into good standing and on the course and of profitability and value creation. So that was Riverview Apartments back in 2004. I stayed there for about a year and a half, maybe 2 years, running the renovation. So I had to go out and hire 4 or 5 guys. I had to order interior packages, light fixtures, cabinet faces, countertops, schedule carpeting, paint, install all of this stuff into it, and then go through a quality control process with my property manager there. And you know what? We did a great job. That property really, I mean, I think we were under budget in terms of the total allocated amount of funds that we had towards the renovation. Our turn schedule was on point. We were turning units really fast and with good high quality. It was being absorbed by the marketplace at really probably $200 to $300 rent pops at the time, which at that time probably was really, really rich. And look, we were able to drive value in a short amount of time at an asset that had been neglected for a number of years. And so I think that would be my one success story of that I can really point towards, where I was hands in, all hands on deck, helping with the turnaround of that property. So it was a great experience for me, and one that I continue to leverage off of to this day.
Yeah, that's excellent. I mean, it's always good to start at the bottom and really understand the fundamentals of the business, and then slowly and steadily move up. And it sounds like you did that. You got all the way up to the CEO position.
Yes. Yep.
That's excellent. So it sounds like this was a story of a turnaround, and you went from like 80% occupancy, maybe deferred maintenance issues and things of that sort, to a property where it sounds like you took care of the deferred maintenance. And did you increase the occupancy back up to 95 plus?
Yeah. So I mean, we got back to a stabilization of in the mid to low 90s. And again, the property had probably a poor reputation in the submarket for having not the best curb appeal, right, and not the best demographic. They just didn't take care of the property. They didn't pay their rent on time, and it was just kind of dragging down. And one property can absolutely drag down a submarket with a bad reputation, right? So we set about charting a course to try to turn that property around, and ultimately try to turn that submarket around, right? It's a little bit of was an interesting pocket, and I think we did that, and I think we did a great job. And it was not just me. Obviously, I just had a small part of helping with the renovation process. My property manager at the time was a grizzled veteran of the industry that had been around for a long time, probably since the late 70s, right? And I mean, she was a taskmaster in every sense of the word. There was no attention to detail that she didn't. She was on top of everything. She was made sure that I was on point with my turn schedule and my quality control. I mean, her energy and her attention to detail was something that I think she set the tone for everybody, right? Whether it's
Yeah.
maintenance, renovation, leasing, collections. She was somebody, a mentor of mine, of, again, having that first manager that I could really observe and look at and watch and see how she attacked her day, was really, really powerful for me. And that.
Yeah, that's actually, it's a perfect segue to my next question. It was going to be how an effective property management team can impact the ROI on a property, because many people look at the sponsors as the one that are going to turn around and improve a property, and uh, really go through that value add business plan. But the property management team obviously plays a big role. So
Yeah.
how does effective property management impact the ROI?
I mean, listen, I mean, it definitely takes a village. Let's just put it that way.
Yeah.
But it really does start with finding the right manager, right? The right leader, that can move the troops forward, right? I mean, there's a lot of moving pieces, and I'm not just saying just the team, but the resident base itself. You got to have a pretty dynamic individual that can sort of wear a lot of different hats, right? I mean, they got to be a leader, they got to be a team builder, they got to have the ability to multitask, they have to delegate, but they also have to have empathy, right? They're dealing with residents, and they're dealing with different circumstances that are, most jobs you don't have to deal with, right? This is people, you're dealing with people's homes, and
Right.
and their expectations are sensitive, right? So you got to have a high level of emotional intelligence that goes with it. You got to be a little bit of a higher achiever, but so there's a flip side to the coin here. You got to have a taskmaster. You got to have somebody diligent, really good at multitasking, really good at delegating, being a good team leader, building a team, setting expectations for your team, which are going to be borne by the sponsor and your regional manager and your asset managers. But understanding, having the ability to assess that and understand it, and then be able to relay that information in a digestible way to your teams, and setting expectations, and then having the will to hold them accountable, right? So all of that's a really key piece to the cog of the wheel here that keeps this engine going. And I mean, I know we're probably going to dive into a lot of the pieces of technology that are really, sort of the trigger points in our industry now. But look, that the people side of the business, when it comes to that head of the spear, is really, really vital.
Yeah. I absolutely agree with you in that the property management team really sets the tone and culture for, the oversight of that particular property, and oversight of the business plan that's being implemented. And I can tell you that, from personal experience, we've worked with many property management teams, and some of them didn't have a big footprint in the particular area that we were looking at. And then if you have a good manager, you have assistant managers that are solid, but they get poached by another property management team, and you don't have a robust presence there, you could be in big trouble. And we've experienced that personally, in that, we had a decent property manager in place. She ended up leaving a week after we closed on a particular property. The management company did not have a large presence in our particular area, and they were hiring temp workers to fill positions, and that just created a cascading issue of problems. And once you start getting investors or tenants into a property that are not good tenants, and they start destroying things or not paying rent as they should, creating issues, you start getting more and more of those tenants, and then it creates a hole that it takes a while sometimes to repair.
Yeah.
So having a really solid property management company is so important. And I really stress to the listeners, if you're looking at investing in a property, really look at the property management company that the sponsor is selecting and make sure that they have a good presence in that area. They have a track record. They have the experience that's needed. We use you guys, Mitch, all the time, and as you know, we love to partner with you, and we've done a lot of good things together. So really happy to have you on the podcast and talk about some of these.
Well, I appreciate that. I appreciate that. And I think the idea, look, I mean, at the end of the day, I think it's lost sometimes. Sponsors don't always value what you're talking about. I mean, and we'll probably go into this. I mean, a lot of owners and sponsors like to manage from a financial statement, right? And it's a lot more than just numbers on a page. It's absolutely putting the right people in the right places in order to execute the things that you need. And when you value that as a sponsor, that makes our job. I think there's alignment there that I think with purpose that I think is absolutely needed in our business from a multifamily perspective.
Absolutely. All right, let's go on to some more horror stories. So maybe you can share something that happened that you were able to really get yourself out of. And maybe you can kind of weave it into this question, the top 3 mistakes property owners make and that cost them, and how these mistakes can be avoided.
Well, that's a good question. I'm trying to think in terms of some situational things, and they're not necessarily relevant to necessarily owners, because they, look, the biggest thing that, well, let's go back. Okay, let's go back to 2008, right? And I think one of the things that we saw in 2008 was, and we can sort of look at what we're dealing with right now as well, right? So up to the point of 2008, where there was a fairly robust run up from a rent level perspective and an occupancy perspective. I think we saw a lot of owners put blinders on to what was actually happening, right? I mean, they were married to their underwriting. And I've found you can't fall too in love with your underwriting. Because once you buy it, it's like a car. Once you buy the car and you drive off the lot, all bets are off. Hopefully in our case, we're appreciating in value. We're not depreciating in value necessarily, but you get really married to your assumptions, right? And the market does not care about assumptions. The market is moving forward whether you like it or not. And whether it was 2008 or whether we're in a situation that we find ourselves in now, where there's a little bit of softening out there, right? That is contradictory to your underwriting model. You've got to be able to pivot and communicate to your investors or make decisions based on what the market is telling you. And so there have been countless situations where people just want to dig their heels in and not really embrace change and embrace the market and what it's telling you. And that can get you in trouble, right? I mean, you'll find yourself left in a cloud of dust. The market will get away from you, and you'll find yourself in a deeper situation and that could have been avoided, right? And so I think those are things that I think are big potential pitfalls for sponsors and owners alike that are, look, I mean, we want to do, look, in the last 10 years, if you weren't hitting your underwriting, you were doing something really wrong, right? The fundamentals of the multifamily business over the last decade have been unlike anything we've ever seen, right? I mean, if you underwrote 5 to 6% rent growth, and you weren't hitting that over the last 10 years or so, you were doing something wrong. And same goes for cap rates, right? Cap rates remained really compressed over that period as well, and so that made underwriting a little bit easier too. And so that that's shifted a little bit over the last 12 months. And I saw the same thing happen in 08. 08 was a lot different than what we're seeing right now from an interest rate environment. So, but it's still, I mean, the idea would be, look, sometimes it's okay to live to fight another day. Time is your friend in this business. And if you buy correctly and you manage and you are connected with a good operator, obviously the big bogey here, the big question mark is sort of how you finance and your debt. But if you have those three components, there's nothing you can't weather, right? And 08 was a great example of that, right? In terms of defaults. Yeah. I mean, in terms of commercial real estate, and I think that whole episode sort of brought to light the resiliency of our industry in terms of multifamily as an investment class, right? Defaults were less than 1% through the whole Great Recession, and so it's a great hedge against inflation. And through the test of time, you can live to fight another day, but you can't ignore the market and the trends, and be so staunchly embedded in your own underwriting.
So just to sum up, because those are some very powerful things you shared with us there. Number one, really can't be tied to your assumptions. You must be dynamic in your thought process and pivot if need be, especially if the market dictates so. Number two, don't count on organic growth. Don't underwrite like massive organic growth, because as you mentioned, we've seen that the past 10 years, but that's not going to continue. It's not continuing now. We can't really see that kind of growth continuing in the near future anyway. And number three, exiting too early, or as long as you have the fundamentals in place, the good debt structure in the deal, time is your friend, as you mentioned. So make sure that you take your time some of these deals and you correct mistakes as you go.
Right.
Awesome. So those are three things that I summarized based on what you told me. Let's now pivot to technology and innovation, because many people are thinking about property tech and what the new trends are and that type of thing.
Mm-hmm.
So can you discuss amenities and tech that tenants really want that boost value of a property?
Sure. Well, look, I mean, we have always been somewhat as an industry, slow adapters to technology. And again, I use my own experience, but I mean, the last 2 decades, right? Since really when I started into the industry, you've seen that we've embraced technology in a lot of different ways. That continues both from an operating perspective and a resident perspective, right? And so I'm excited about what the future holds in terms of what kind of both operational and the resident experiences can will benefit from these technologies. I will say this from a resident perspective, right? The technologies that we feel are going to be really beneficial to help drive value. First and foremost is Wi-Fi, right? I mean, bundled Wi-Fi at your properties. It's just it's almost as it's the there was a period of time where everybody wanted to live in a gated community. Well, now everybody wants to live in a Wi-Fi bundled community where that's included in your rent, right? So a big and robust, strong Wi-Fi component to your communities, I think is, if you haven't underwritten it, you should start underwriting for that. And certainly there's solutions out there that you can retrofit to on existing deals. So I think that is probably a leader. And then from additional technology perspective, from a resident experience perspective, smart home tech is here to stay as well. I think
like smart thermostats.
Yeah, thermostats, keyless entry. There's features that allow you to detect leaks. If there's a leak in your apartment, it will let you know on your phone. Obviously all the bells and whistles as it pertains to communication with your office, right? Being able to pay online, being able to do all the things from a mobile perspective, anything that you can do on your mobile phone that's inside of your apartment is going to be something that I think will continue to help drive value and maintain popularity in your communities.
Are you starting to see AI supported devices or software that are out there
Yes.
for property management?
Yeah. So especially on the marketing side, right? So the marketing side is definitely embracing AI, and they've had to. And there's a lot of efficiencies there that makes sense. So I think there's a program called Perk that we've utilized at a number of our properties, right? It's an app that you can download. And it's multifaceted, and there's a part of it is attached to your website too in the way of a chat bot. And so and through sort of text communication back and forth. So those are programs that are absolutely our industry is embracing and learning from. I think we're still in the infancy stages of the kind of impact that it will have. But I certainly think that AI is going to be something that will be here to stay.
You have any other recommendations? You mentioned, is it Perk, PERK?
Yeah.
Like any other names, especially for bundled Wi-Fi? Like, is there a particular company that you like?
Yeah, there's so many out there. I don't have a one particular that I would necessarily put my stamp of approval on just yet. But there are a lot of great providers out there that can help you.
Okay, all right. So a good Google search goes a long way. All right. Excellent. Anything else technology innovation wise that we may have missed that you can think of?
Yeah, no, I mean, I think, technology, like this isn't new, but I think our ability to interface with our resident base is still very, very important.
Yes.
In a way that's efficient and technology driven. So, I think, we certainly utilize Rent Cafe through our portfolio accounting system, which is Yardi. And they have a lot of different functionality within the Rent Cafe system that allows you to interface and engage with your resident base. So I think when I think about technology in terms of how we can use it a little bit better, I love the engagement piece of technology that allows us to do it a little bit more efficiently than we have in the past. So, I think people, when you think about retention, and just trying to create a sense of community within your apartment homes, you want to have a high level of engagement. So I think leaning in on the technologies that provide survey capabilities to push out that kind of content and get some feedback, right? Getting feedback. I mean, your residents want to be heard, right? And so you want to give them a platform by which they can tell you, hey, look, I love the community, but it'd be great if we were able to have certain functions on a weekly basis or a monthly basis, and we can send out surveys that help us sort of ascertain what they want to see happen in terms of functions or amenities. And so those are key. Leaning in on that technology, I think is again not necessarily new, because we've been utilizing the Rent Cafe piece now for quite some time, at least for a number of years. But I think we're going to continue to use that, because I think we're at a really interesting inflection point in our demographic, right? So, there's a huge swath of people that they are all in on technology and AI and everything else that we can push to them that is technology related, that is, on your phone. And so, but there's also still a renter profile that, is a little resistant to that. So we're in a weird little dynamic here that I think is interesting. We have to wear both hats here, and not be so technology driven,
right,
or facing, because you will leave behind a pretty large demographic that would still like to come into the office and chat face to face.
Sure.
So
I've read a recent article that tenants increasingly would rather communicate regarding maintenance issues or bills to pay or what have you on the phone rather than going to the office. I think a perfect technology would be an AI interface where the tenants could communicate maintenance issues, or payment issues or whatever it may be, and they would get real-time responses and scheduling done by that AI device, and these issues would be taken care of. Is there anything like that out there that you know of?
No, I mean there's Maintenance Mobile that we have been using, and again it's an app that our maintenance teams have on their phones, right? And so when maintenance tickets come in, they're coming in real time, right? So there is the ability to there. I don't know if there's an AI. I don't know if there's AI technology attached to it.
Okay.
But it does have the ability to at least you're able to communicate in real time with your maintenance technicians when something goes wrong, and they can respond back to you, through this mobile app.
Okay.
And so we've utilized that. And I'm sure that I'm missing some products out there that are probably developmental stages of that. And
Right.
look, that's the other thing too. I mean, look, technology is great. I love it, and I want to embrace it, and I want to be forward thinking. But there's so much of it out there. It is sensory overload, and
Yes.
we might want to go. I don't know if you want to pivot into that or not, but there's some pitfalls there too, right? Technology is great until it's not, and there's a lot of things that need to be considered before bringing on new technologies, right?
Yeah.
And understanding what that is and some of the pitfalls is something that's relevant in our business. So.
Absolutely. As far as prop tech and innovation, there's something else that we've implemented in one of our properties in DC, where we have a company called Zome, who installed free thermostats, not only the standard thermostats, but also hot water heater thermostats. And they play in the energy market so that if there is a high demand during peak hours, they can decrease the entire building load of energy demand. And there's a significant amount of profit to be had in that space. And they share that profit with the sponsor. So they install these things for free, and then there's a profit sharing on top of that. So it's a really great model. It's still in its infancy. We haven't really seen the benefits just yet, but we still have the thermostats, that they've installed. And in fact, on top of that, they're going to put solar on the roof plus a battery. So that will also help decrease overall load. And again,
how many units?
No cost to us at all. It's a mid-rise of 49 units.
Yeah. It's funny. I had a conversation with a client because who's from overseas, and they're like, why isn't the multifamily space embracing solar technology? And I think to your point, we're getting there. I think we're on the front end of that wave from a solar technology perspective, for sure.
Yes. Yes, absolutely. So let's talk now. Let's segue into another question here. What types of properties are the easiest and hardest to manage, and why?
Well, that's a good question. I do want to just real quickly reiterate one thing about technology too that
Sure.
I wanted to get across, and that is, look, I mean, I think it's important that from an operator's perspective, everybody gets sort of really excited about the shiny new toy that's out there, right? And there's a lot of shiny new toys in the way of technology that have perceived value to our residents and to the underlying business, right? And I think it's important that we concentrate on best in class on specific things, whether it's smart home technology, whether there's marketing trends out there CRM and knock are two great pieces of technology that we've embraced in terms of how we monitor traffic and prospects, right, that are coming in looking for their homes, whether they be digitally or in person. But I think we got to factor in the training component that goes into the usage of these technologies, right? And the administration of it, because I think we all go with the assumption that, well, if it's a piece of technology, it's going to create efficiency. And that's not always the case, unfortunately. I mean, we've encountered things that, and I think in the context, the training component and the administrative component and the context relative to employee turnover can't be ignored, right? So we're in a period of higher than average employee turnover in our industry, and probably really throughout the country and multiple industries. And so when you're dealing with that on a consistent basis, I mean, it's nearly impossible to maximize, the full breadth of a lot of these technology pieces, because you're always playing catch up from a training perspective. When you're dealing with employee from an on-site level perspective, and then the administrative side of these tools can be relatively expensive as well, and time consuming. And again, and if you're not, there's no such thing as taking your hand off the wheel when it comes to these technology pieces. You've got to be engaged. And if you're not gonna, the tool becomes a waste of money and a waste of time, and it's not going to be effective. And so,
yeah. I mean, that's a great point. And I'll just give a quick example of that. There's a property in Atlanta, one of our first properties that we purchased, where we were the primary sponsors, and we adopted a solar lighting technology that has never existed in any multifamily complex prior to us putting it in. We were thinking we're being innovative. We're, at the forefront of solar technology, but the damn thing never worked. We had it for years. It just created problems. It was hard for the staff to try to fix issues. We were trying to turn off the Georgia Power lights and use the solar lighting only, and didn't turn on at night at times. So, it was like an awesome idea, but it really, I learned from that, like as much as we want to implement some of these high tech items, it's often best to hold back and let others try it, and come back to it if it makes sense.
Yeah. The execution, early adapters, they're the guinea pigs, unfortunately.
Yes.
But so getting back to your question about, you said, what are the easier, the harder properties?
Yeah, easiest and hardest to manage. What type of properties are the easiest and hardest to manage?
Well, listen, I mean, you could ask 20 different people and probably in our office, and they probably give you 20 different answers. But I think there's some context to the things that so I'll start with the misconception that if you own and operate a Class A new development deal in a well-located area, then you're just coasting. You don't really have to do a lot. And I would say, listen, yes and no, right? So there's, from a maintenance perspective, you're probably going to be a little less haggard with regards to having to contend with a lot of stuff. Although I will say this, I'll tell you, new products that, in bulk, like appliances and HVAC equipment, you dealing with warranty issues and manufactural defects is a pain in the neck as well. And we see a lot of it. Unfortunately, they just don't build them like they used to, right? So you have to contend with that, and that can be problematic. But look, more money, more problems is the adage, and that happens at a lot of these sites that are the clientele and the demographic are paying a tremendous amount of money in rent on a weekly basis or a monthly basis. I'm sorry, and so their expectations are very high. We have a deal. We have a high-rise deal in Sarasota that we manage, and look, I mean, it stays full. Nobody wants to leave. But man, the residents have high expectations, right? They want what they want and they want it now. And that can be very taxing on your office staff. And so I think there's a misconception that you don't have to worry about too many things when you're dealing with a higher paying clientele, but you do. And look, as well, look, you're under the gun and under the microscope a little bit more, given the fact that the price per pound on these assets are a little bit heavier. So your sponsors are putting over a hefty chunk of change, and so they have expectations too that are very lofty, and that doesn't always align with sort of your resident profile either. So those are difficult assets. It's a different challenge, right? Much different than say a value add deal, right? A value add deal that has a ton of deferred maintenance, right? That has some challenges demographically, maybe challenges from a submarket perspective. There's a lot. Those are by far probably the hardest deals to manage, right? Because you're having to manage the physical plant in a very proactive way, very laborious, very expensive. And they've been managed multiple times by multiple different operators. So you don't know what the kind of quality of maintenance has been on these sites. So, you're having to repair things that probably weren't repaired the right way going back, many years. So the maintenance side of the equation on, older properties that have tons of deferred maintenance and have gone through multiple managers can be taxing on your maintenance staff, right? And then further to that, look, typically when you get into these deals and you have another component that maybe you don't have as much, even though in this day and age you do, but delinquency issues are taxing. I mean, that's a whole nother set. That's a full-time job at times from a delinquency perspective. And so those are difficult assets to get your arms around. And some things, again, sometimes you're situated in a submarket that are surrounded with properties that are being undermanaged or underowned, and there's not a lot you can do. And you're sort of at the mercy of a bad submarket. So
it sounds like this is what I think. I think as you mentioned, new builds have their own issues, but properties that have been around since, like, say built 2017, 2018, still relatively new. All the issues that come up with a new build have been taken care of at that point. Potentially, there's still a value add because the property's been around for 5, 6, 7 years maybe. That's the sweet spot that I see. I think those are really solid properties.
Yeah.
They don't have much maintenance issues. The tenants are typically really solid. Class B is pretty good, like maybe 2000s plus, or maybe even 90s plus properties are pretty good. I feel like the older vintage, there's just a lot of maintenance issues that come up. It's not necessarily a bad property, but I would say maybe harder to manage because of those issues, and then the types of tenants that may want to live there. So my take is, as far as the easiest would be, like kind of around the 2015 to 2018 vintage, class maybe A minus, like core plus asset. That's my take.
Yeah.
What would you say?
Fair. No, that's fair. And look, we've got deals that we've managed that were built in the mid 70s that, are fairly easy to run because they're well located, right? They're well located. And again, like and I go back to some of the guys that I have mentored with, and Rob Johnson, again, a legend in our industry and the founder of First Communities. I mean, he's like, listen, you from an exterior standpoint, you want to make sure that you're buying a deal that's an all brick deal, right? I mean, all brick, new roofs. If you have an all brick new roof deal and you're well located, there's nothing you can't manage through, no matter what the age is. So, but there is a useful life for things, and you got to account for that, especially you don't know what's underground. That's the key point on a lot of these older deals.
Yeah.
When they have, you're built in the 80s or even the early 90s and it's galvanized. Eventually you're going galvanized supply lines. You're eventually going to have issues, right? And it's just, you don't know when, you don't know where, and you don't know how much it's going to cost you. But those are all risks that you got to assess when you're going about your underwriting. But I agree with you. That is not a bad sweet spot to be in, for sure.
All right, and we're running close to time here, but I just want to ask you maybe a couple more questions.
Yeah.
What are some overlooked ways property owners can save money in managing investments that maybe we haven't discussed?
So saving money.
Yeah.
Well, look, I mean, I think you certainly want to, and you and I've talked about this before. I mean, you want to take advantage of your managing agents' scalability, right? So, I mean, when you're dealing with operators that have pretty large footprints and good scale, you want to really hone in on the relationships that they have with national suppliers, or national ILS and marketing companies, to take advantage of any pricing breaks that you might get as a result of that scale. So I think that's a key component to just making sure, if that's available to you, that you take full advantage of it.
Taking advantage of economies of scale.
Yes.
Basically.
Yeah.
Excellent. And one more question. If you could offer one golden piece of advice to a new real estate investor regarding property management, what would it be? Maybe one key takeaway that we can get.
Yeah, I think alignment is key, right? You want to be able to, hopefully your managing agent has seasoned and tenured experienced managers, and there's a wealth of information and data that's tied to your managing agent that is relevant, and I think you should take advantage of that. We have clients like yourselves that, I mean, you sit down at the table and we're going through line by line your underwriting and checking boxes, right? I mean, I think you want to come from an operational perspective, right? And if you can sort of attack your underwriting through the lens of an operator by utilizing your managing agent as that lens, then I think you're going to be able to mitigate a lot of risk and a lot of unknown that's out there. And I think that's a key component. We've got clients out there like yourself, like I said, that will absolutely say, hey, I'm going to run this by you, whether it's, average expenses, whether it's rent growth, what we're seeing from a transactional perspective and in terms of cap rates. We like to align ourselves with owners that are willing to listen and hear our thoughts on where we think deals are attractive and where deals are not. And so I think that alignment piece is key and gives you the best opportunity to, again, manage through the good times and the bad times. Because we're always going to hedge. I mean, I think most management companies, I mean, I think we're always got eyes in the back of our head saying, all right, we want to look and make sure what's coming that nobody hasn't experienced before. and be able to share those potential pitfalls out there with you guys. So I think that alignment piece is really, really crucial.
Yes.
Um,
Yeah, I would 100% agree. One question I always ask when we are in our investment committee, we're thinking about acquiring a new asset. I always ask, what does First Communities think? Did they look at the asset? Do they think that we can hit our projections? Do they agree that this is a good area to invest in? It's so important to have that alignment because if you guys, for example, don't think the deal makes sense, we're not doing the deal. It's just part and parcel of how the relationship works.
yeah,
Well,
it's
yeah, go ahead,
yeah,
Mitch.
yeah. No, I mean, I value it so much. And again, we have clients that they don't want to know what we have to say. And again, we're on the precipice of a lot of uncertainty. And well, we're not on the precipice, we're in it. We're knee deep in it. And I think where that alignment comes into place so importantly is in times like this. And what I will also tell you is that asset manage and manage your property with more of a look forward basis. There's a lot of asset managers and owners that like to look in the rear view. Okay. The rear view, we're past it. That was 2 months ago, 3 months ago. Now, granted, you certainly don't want to repeat your mistakes, and you want to know what your mistakes were, but you can't manage through looking through the rear view. Always be looking forward, always be looking for what the market is willing and capable of giving you, and take advantage of it where you can. And so again, that's also part of the alignment piece as well.
Absolutely. Well, Mitch, this was phenomenal. We spoke about investments, profitability. We spoke about common mistakes and solutions, technology, innovation. We spoke about relationships. We spoke about financial issues. This was a phenomenal episode. I really appreciate you spending your time and educating us on all these aspects. If our listeners want to get in touch with you or First Communities, how would they do so?
Sure. Listen, I have an open door policy. I always tout it. My email address is mharrison@firstcommunities.com. Happy to address the things that we're seeing out there in the marketplace, common questions you might have about Management 101. I'm an open book and an open door. So by all means, reach out to me and I'll help in any way I can.
Wonderful, Mitch. Thank you so much.
All right. Thanks for having me.